The average freelancer overpays between $3,000 and $5,000 in taxes every single year. Not because they are doing anything wrong, but because they do not know about the legal tax strategies sitting right in front of them. In this video, we are going to fix that, specifically by showing you how retirement accounts are the single most powerful legal tax reduction tool available to every self-employed professional. By the end of this video, you will know exactly how much tax you can save, which accounts to use, and the precise dollar impact at 3 different income levels. Welcome to Freelancer Retirement Lab, where we help self-employed professionals build real financial security through data-driven retirement and tax planning. Subscribe now if you have not already. New videos every Tuesday and Thursday. Let's talk about the freelancer tax problem. Before we get into the solutions, let us understand exactly what you are up against as a freelancer. When you work for a company, your employer handles payroll taxes, splits your Social Security and Medicare contributions with you, and often provides a retirement match. You see one number on your paycheck, and that is what you keep. As a freelancer, you pay the full self-employment tax rate of 15.3% on your net earnings. That breaks down to 12.4% for Social Security and 2.9% for Medicare. On top of that, you pay your regular federal income tax, which can range from 10% to 37% depending on your earnings. So here's the real picture. A freelancer in the 22% income tax bracket is effectively paying 37% or more on every dollar earned, 15.3% in self-employment tax, plus 22% in income tax, before any state taxes. That is why tax strategy is not optional for freelancers. It is essential. How retirement accounts. Reduce your tax bill. Here is the core mechanism you need to understand. When you contribute to a solo 401k or a SEP IRA, every dollar you contribute is deducted directly from your gross taxable income. This is called an above-the-line deduction, which means it reduces your adjusted gross income before you even calculate what tax bracket you fall into. This is critically important. It is not just a 22% saving on the dollar, like a standard business expense deduction. Contributing to a retirement account reduces both your federal income tax and your self-employment tax simultaneously. Here is the math. For every $1,000 you contribute to a solo 401k or SEP IRA, a freelancer in the 22% tax bracket saves approximately $370 in total taxes, $220 in income tax, plus about $150 in self-employment tax savings. At the 24% bracket, that saving rises to roughly $390 per $1,000 contributed. At the 32% bracket, it reaches approximately $440 per $1,000. This means the government is essentially co-funding your retirement. Every time you contribute, the IRS reduces your tax bill automatically. There are 3 retirement accounts every freelancer should know about for maximum tax reduction. Account 1. The Solo 401k. In 2026, you can contribute up to $24,500 as the employee, plus up to 25% of your net self-employment income as the employer, with a combined maximum of $72,000. Every dollar is tax deductible. This is the most powerful tax reduction account available to solo freelancers. Account 2. The SEP IRA. You can contribute up to 25% of your net self-employment income, with a 2026 maximum of $72,000. Slightly simpler to set up than a solo 401k, but equally powerful as a tax deduction. Best suited for high earners or freelancers who want simplicity. Account 3. The Roth IRA. The 2026 limit is $7,500 per year, or $8,600 if you are 50 or older. Roth contributions are not tax deductible today. However, every dollar grows completely tax-free and is withdrawn tax-free in retirement. This account does not reduce your taxes now, but it eliminates future taxes entirely. The strategic move is to combine a solo 401k or SEP IRA for immediate tax reduction with a Roth IRA for long-term tax-free growth. Real dollar savings. $60,000 income scenario. Let us make this real with concrete numbers. Meet Alex. Alex is a freelance graphic designer earning $60,000 per year. Single filer, no employees. Without any retirement contributions, Alex pays approximately $8,478 in self-employment tax and $6,617 in federal income tax, a total tax bill of roughly $15,095. Now Alex opens a solo 401k and contributes $15,000 for the year, 25% of gross income. That $15,000 contribution drops Alex's taxable income from roughly $52,935 down to $37,935. The result? Alex's federal income tax drops by $3,300, and because the lower taxable income reduces the QBI deduction calculation, the total tax saving comes to approximately $3,250 in the first year alone. Alex is not spending $15,000 to save $3,250. Alex is saving $15,000 for retirement and getting $3,750 back from the IRS for doing it. Over 10 years, that $3,750 annual tax saving alone, invested at 7%, compounds to over $51,000. Real dollar savings. $100,000 income scenario. Now let us look at a mid to high earning freelancer, a software consultant bringing in $100,000 per year. Without retirement contributions, this freelancer pays approximately $14,130 in self-employment tax and around $14,000 in federal income tax. Total tax bill, roughly $28,130. Now this freelancer maximizes their solo 401k, contributing $24,500 as the employee, plus approximately $17,000 as the employer portion. Total contribution, $41,500. That $41,500 deduction reduces taxable income dramatically. The federal income tax saving alone is approximately $9,130. Combined with the self-employment tax impact and the QBI deduction shift, the total annual tax saving comes to approximately $11,000. The freelancer kept $41,500 out of the IRS's hands this year, invested it in their own retirement account, and saved $11,000 in taxes in the process. At a 32% marginal rate, every $1,000 contributed to the solo 401k saves approximately $440 in taxes. Real dollar savings. $150,000 income scenario. Let us look at one more scenario. A high-earning freelance consultant at $150,000 per year. At this income level, without retirement contributions, the total federal tax burden, income tax plus self-employment tax, approaches $42,000 or more, depending on deductions. By maxing out the solo 401k at the full $72,000 combined limit in 2026, this freelancer reduces their taxable income by $72,000. The federal income tax saving is approximately $7,280 at the 24% bracket. Including self-employment tax impact, the total annual tax saving exceeds $20,000. That is $20,000 the government would have taken, that instead sits in this freelancer's retirement account, compounding tax deferred for the next 20 to 30 years. The self-employment tax deduction most freelancers miss. Here's a deduction that many freelancers do not even know exists. You can deduct 50% of your self-employment tax directly from your gross income. This is an above-the-line deduction, meaning it reduces your taxable income automatically when you file. On $100,000 of net self-employment income, your self-employment tax is approximately $14,130. You can deduct half of that, $760, from your taxable income before calculating income tax. This deduction happens automatically on your Schedule 1 when you file. But it is worth knowing about because it compounds with your retirement contributions to create a powerful stack of tax reductions. The QBI deduction. An extra 20% off your taxable income. Here is another deduction that works alongside your retirement contributions. The Qualified Business Income Deduction, known as QBI, allows eligible freelancers to deduct up to 20% of their net self-employment income from taxable income. In 2026, this deduction begins to phase out for single filers with taxable income above $200,900 and phases out fully at $250,900. Here is why this matters for retirement planning. When you contribute to a solo 401k or SEP IRA, you reduce your taxable income. A lower taxable income means you stay well within the QBI deduction threshold, keeping that extra 20% deduction intact. For a freelancer earning $100,000, the QBI deduction alone can be worth an additional $4,400 to $5,000 in tax savings, and your retirement contributions help protect it. The stacking strategy: how to combine every deduction. The most tax-efficient freelancers do not rely on one deduction. They stack them. Here is the full legal tax reduction stack for a freelancer in 2026. Layer 1. Deduct 50% of your self-employment tax. This is automatic on your tax return. On $100,000 income, this saves approximately $1,550. Layer 2. Contribute the maximum to your solo 401k or SEP IRA. On $100,000 income, a $41,500 contribution saves approximately $9,130 in income tax alone. Layer 3. Claim the QBI deduction, up to 20% of net business income. On a reduced taxable income after retirement contributions, this saves approximately $3,500 to $4,500. Layer 4. Deduct business expenses on Schedule C, home office, equipment, software, professional development, health insurance premiums. A well-documented freelancer can find $10,000 to $20,000 in legitimate business deductions here. Layer 5. Contribute to a Roth IRA. No immediate tax saving, but every dollar grows tax-free, reducing your future tax burden in retirement. When you stack all 5 layers, a freelancer earning $100,000 can legally reduce their effective tax rate from 28% to 32% down to 15% to 18%. That is a real dollar difference of $10,000 to $15,000 per year, staying in your pocket and your retirement account instead of going to the IRS. Common mistakes that cost freelancers thousands. Let us cover the mistakes that are costing freelancers money right now. Mistake 1. Not contributing to any retirement account. This is the single most expensive mistake. Every year without a solo 401k or SEP IRA is a year you pay full income tax on every dollar earned, with no deduction, no compounding, and no wealth building. Mistake 2. Missing the solo 401k setup deadline. The solo 401k must be established by December 31st of the tax year. Miss that date and you cannot claim contributions for that year. The SEP IRA is more forgiving. You can open and fund it right up until your tax filing deadline, including extensions. Mistake 3. Under-contributing because the account feels optional. Every dollar you do not contribute is a dollar the IRS taxes at your full marginal rate. Contributing is not just saving for retirement, it is immediately recovering money from the government. Mistake 4. Ignoring the QBI deduction. Many freelancers in professional services assume they do not qualify. Check with your CPA. The 2026 phase-out thresholds are generous enough that the majority of freelancers qualify for at least a partial deduction. Your action plan. Here is exactly what to do after this video. Step 1. Open a solo 401k or SEP IRA if you do not have one. Fidelity, Vanguard, and Schwab all offer free accounts. For maximum tax savings at most income levels, start with the solo 401k. Step 2. Calculate your target contribution. Multiply your expected net self-employment income by 0.20 as a starting target. This is your retirement contribution goal for the year. Step 3. Set aside that contribution monthly. Do not wait until December. Monthly contributions prevent you from spending money you will wish you had saved. Step 4. Stack your deductions. Work with a CPA who specializes in self-employed clients to claim the SE tax deduction, the QBI deduction, and all legitimate business expenses on Schedule C. Step 5. Open a Roth IRA once your solo 401k or SEP IRA is established. This adds the tax-free growth layer on top of your current year tax deduction. The legal tools to dramatically reduce your tax bill exist right now. The solo 401k and SEP IRA are not loopholes. They are accounts Congress specifically created to help self-employed Americans save for retirement, with the added benefit of reducing taxes every year you contribute. If you found this video useful, drop a comment below with the one action you are going to take this week, whether that is opening an account, calculating your contribution number, or booking a call with a CPA. Like this video, subscribe to Freelancer Retirement Lab, and check out our previous videos on the solo 401k versus SEP IRA comparison and how much freelancers should save each month. See you in the next video.